Diego, thank you very much for joining me today.
It's my pleasure, Joanna. Thank you for having me.
And just tell me, what market trends have surprised you in 2025?
Well, I guess if we speak of trends, the strength of the AI hasn't really surprised me. I think it's in line with a game changer technology. At the same time, I think the momentum and how these things have played out is starting to reach levels that perhaps we thought might be unrealistic, like having Nvidia breaking the 5 trillion level. I'm old enough to remember when a $1 trillion market valuation was considered to be truly exceptional. I think in that sense, the dynamics around AI are, reminiscent a little bit of the dot-com, a game changer technology that is attracting a tremendous amount of investment, that is leading to a meaningful amount of capacity and arguably overcapacity based on good reasons, like a very attractive outlook and expectations of returns and perception that perhaps strategically I cannot miss it and be part of it. But I think we are probably, this trend is hard to, I don't have a crystal ball, I don't know exactly when things will turn around, but I do think the dynamics we're witnessing are, again, reminiscent of the dot-com, and what we witnessed then was how these game changer technologies were available in huge size, and eventually there was some degree of inability to realize the expectations. It was assets were written off through overcapacity and other things, and that led to a meaningful collapse in valuations. What we learned then, and I think will be true again, is the winners and losers that the market is identifying today may not necessarily be the ones that eventually play out. And I think this flattening of the world through AI is real. So the bigger winners will be perhaps many industries, education, healthcare, and many others as we transform the universe. But I think that trend hasn't surprised me because it's been around for a while, but it has surprised me to the extent that the acceleration and the levels. And it's going to be a fascinating next few months to see how the movie plays out.
And how is current market volatility challenging quants around the world? And what's your take on managing volatility?
So we have a volatility. We're volatility and tail risk managers. We think about volatility markets more from the perspective of protection. We think about it more as options. So we don't really, for us, we only buy options. Everything we do is limited loss. And so for us, investing or $1 million of premium in S&P puts is directly competing with $1 million in VIX calls or a hybrid. So volatility is a key input into the pricing of options, but is not necessarily the only driver of returns. So when you think about risk management, we like the idea of long-only options because we know our risk and our downside with 100% certainty, what we call VAR 100. At the same time, it gives us this ability to create different payoffs, different levels of reliable reactive convexity, which is what we're after. We need to do that mindful of cost and carry, and so we effectively manage portfolios that are multi-asset, multi-maturity, multi-strategy. And whilst volatility is, as I said, a key input, you need to be mindful of this reliability. For example, if your goal is to protect an equity portfolio and you were to buy the VIX, there are scenarios where the equity collapses and the VIX doesn't really perform, in which case your hedge or your protection was not really reliable enough. So I think the VIX or volatility or other ways have a role to play, but this is a game of reliable reactive convexity. And one of the challenges faced this year, perhaps linking to the first question, is what's been happening in the dollar and fixed income, which are conventionally defenders in portfolios during crisis. You expect fixed income and duration to come to the rescue. You expect the dollar to be a bit of a safe haven. And we've seen all the dynamics around Liberation Day challenging that idea. So I think for strategies and vol and tail risk managers around the world, this is a threat and an opportunity. I think the dollar at the end of the day continues to be very positive carry. I personally think it's down but not out. And some of the dynamics we're witnessing are the result of a lot of people waking up to the reality that when they buy US equities or US fixed income, there's also a currency risk, which historically was second or third order. But when you get your equities down 15% and the currency down 10%, that compounded effect was no longer negligible. So that's led to the world, having to ask an additional question when you think about, investing in U.S. assets, and that is inherently driving, volatility and protection, etc. So that, I think, it's a dynamic that needs to be considered. And as I said, I think it's a threat for those who drive the cars with the rear mirrors. Is an opportunity as we look ahead into how we might position ourselves with potential attractive protection with positive carry, which is not something you find every day.
And given all of those factors, what would your predictions be for 2026? And specifically, what market factors are you looking at and why?
I think 2026 is going to be a volatile year. I think to the points discussed earlier, we're seeing valuations being stretched, market being very polarized. We're seeing certain markets like gold giving us strong signals, entering new paradigm shifts. A lot of people talking about 10,000 gold. We might as well see 1,000 gold down move in any day, given the extreme positioning. I think the market is in that transition into, what's next? And perhaps the bigger realization that from a macro perspective, the level of deficits and debt might be unsustainable, yet it might be hard to reverse. So I think the ideas of my book, the anti-bubbles, Gold's Perfect Storm that I published in 2017, which was, every time we have a problem, mommy and daddy are trying to fix it with, printing, borrowing, and inflating the weight of the trouble. I think that thesis it's not only survived, it's been reinforced, and we're witnessing, I think, market dynamics that are giving us signals that this is accelerating. Those structurally high inflationary pressures that come from monetary and fiscal abuse are being somewhat offset by the AI forces we're talking about with productivity changes. And so I think to the extent that these forces change direction or they suddenly move in the opposite direction, like volatility up and some of the AI dynamics changing, I think you might see how correlations and volatility can potentially compound into levels of risk where some of the apparent diversification of portfolios was not really there. That risk of what I call false diversification or hidden leverage is very real. 2022 was a year where we saw equity down, fixed income down, exposing that 60-40 balance portfolio. I think we are potentially going to witness some of those correlation shifts, testing some of the real diversification of portfolios, and that's when things really can accelerate, which, in my opinion, will lead to more of the same, printing and borrowing, which basically brings us back in this cycle of basically where I think the end game is stagflation. So from a macro perspective, what we're witnessing is just how certain patterns of monetary and fiscal abuse are trying to solve problems, effectively not really solving them, but they're delaying, transferring, transforming, and enlarging those problems. And so I think the 2026 could be a year where some of these dynamics perhaps accelerate further. And as I said earlier, I think it's a source of opportunity, but also risk.
So prepare for more volatility on the horizon. Diego, thank you very much for your time.
It's been my pleasure, Joanna. Thank you so much.